Let's get another look at Cava. Those shares are slipping despite posting a revenue and earnings beat, down about 7.5% right now. Joining us now is Nick Setyan from Wedbush. Nick, why is the stock lower here? We had same-store sales that beat, top and bottom line beat, full-year guidance looks pretty strong. What are we seeing?
Yeah, there's two things. One, the Whisper numbers were closer to mid-single digit in terms of the comp. They did a 2.3 versus a 0.9 consensus. But again, the Whisper numbers were a little higher. And then to the guidance, essentially they're raising guidance by the amount of the beat, which doesn't allow numbers to really go up for the rest of the year. Again, I mean, this management team has been conservative since the IPO, pre-IPO. It's not a surprise to me that, the numbers necessarily they're not allowing the numbers to fly off the page. But I'm going to chalk it up to their conservatism. And I do think essentially, tomorrow, a lot of especially the small cap growth funds are going to buy this dip.
It does seem like we've been talking a lot about the bifurcation of the consumer. It has been playing out in real time among the restaurant stocks. Look no further than today. We know Cava has been sort of lumped in with the Chipotles of the world. I'd argue Dutch Bros is probably in that bucket as well. And then on the other side of the equation, just today, Dine Brands announcing more promotions, more price cuts across its chains, and you've got the rollout of the McDonald's value menu again this summer. How to navigate this environment? What does it say about the consumer?
Look, I mean, essentially it's about exposure to the lower income consumer. And the fast casual category, Cava, Chipotle, they just have less exposure to the lower income customer. Names like Applebee's, which is Dine Brands, McDonald's, et cetera. I mean, the QSR category, a third of their transactions are that, under 75K, perhaps even under 50K, consumers. So there's just a lot more exposure to the lower income household within QSR, and then obviously within certain segments of full service, which, Applebee's and IHOP certainly fall into those segments. So that's the bottom line. There's just less exposure to the lower income customer.
But speaking of that customer exposure, Cava did say that they hiked their prices slower than some competitors to keep momentum going. And they talk about this effect of high-end consumers trading down from dine-in to Cava. So do you expect that to continue, or is it a signal that the macro environment eventually is going to affect even a name like Cava that's got this strong growth profile?
That's some smart, language that Cava is using there. I don't necessarily think it's going to catch up to Cava. They're actually raising their, margin guidance by 100 basis points, which is still going to be conservative as the year progresses. So a name like Cava, names like Chipotle, they have room to take less pricing because of how profitable they are. And so I think, that's part of the advantage. That's part of the reason why they're going to continue to win, is because, number one, they are a relative value. Number two, that relative value advantage is only going to grow. They know that, and they're just doubling down on it.
So what category do you sort of put those two in, completely separate from some of the fast food? Are there other, even if they're not exactly the same as these brands, that you think are in the cohort?
It's all about the perception of relative value, right? So the five names that we've talked about going into this year, Domino's within QSR, really just Domino's within QSR, within fast casual, Chipotle, Cava. Roadhouse is the only winner within casual dining, and then Wingstop, which is kind of a hybrid QSR slash fast casual. So those are really the five names that we really continue to like.